America loves a tidy narrative. It's a comforting story where every crisis is a surprise, every collapse is a tragic accident, and every market failure is an event no one could have possibly predicted. But what if that story is just that, a story? What if the truth is messier, more complex, and far more unsettling? The reality is, you were never supposed to see the cracks forming long before the headlines caught up. The signs were all there, but they were hidden in plain sight, disguised in technical jargon and buried in obscure data sets. We're talking about liquidity data that was quietly drying up, Treasury auction failures that signaled a lack of demand for the world's safest asset, and repo market distortions that showed a system under immense strain. We saw institutions, big, powerful institutions, borrowing at rates they swore they would never touch, a quiet, desperate panic that never made the evening news. What really broke the system wasn't a single, dramatic event like a meteor strike. It wasn't one bad decision or one rogue trader. It was the slow, steady accumulation of risk, an accumulation of leverage, piled higher and higher on a shaky foundation, an accumulation of denial, from experts and officials who insisted everything was fine, and an accumulation of incentives that were perfectly designed to mask fragility, rewarding short-term gains while ignoring long-term rot. Think about the story you were told. The economy is strong, they said. Unemployment is at historic lows. Consumers are resilient, spending freely. And the markets? They're efficient. A perfect reflection of all available information. It was a beautiful, glossy picture. But underneath that surface, a different reality was taking shape. Liquidity, the lifeblood of the financial system, was evaporating. The quality of collateral being used to back loans was deteriorating, and the cost of borrowing short-term cash was rising faster than the official narratives could possibly explain or hide. The system was silently seizing up. Here's a fundamental truth you need to understand. Markets do not move on their own. They are moved. And the force that was moving them in those final months before the visible break wasn't optimism. It wasn't brilliant economic policy, and it certainly wasn't confidence. It was fear, a quiet, institutional fear. The fear of a bank watching its funding sources tighten overnight. The fear of a fund manager seeing their balance sheet destabilize in real time. The fear of traders whose hedges, their safety nets, were suddenly failing them when they needed them most. This wasn't the panic of the general public. This was the cold, calculated fear of the insiders. So why didn't we hear about it? Why did America pretend not to see? Because acknowledging the truth would have been catastrophic for the official narrative. It would mean admitting that the entire system was far weaker than advertised. It would mean confessing that it was more leveraged than anyone was comfortable with. And it would mean revealing that our modern economy is dangerously dependent on the constant, uninterrupted flow of short-term liquidity, a flow that policymakers couldn't fully control or explain. It's easier to maintain the illusion of stability than to confront a fragile reality. When the warning signs did appear, and they did, the official line was always the same. When we saw dislocations in Treasury futures, strange behavior in the bond market, they called it a technical adjustment. When there were silent, unexplained drains in bank reserves, it was dismissed as normal fluctuations. When the basis spreads, the difference in price between related financial instruments, widened to alarming levels, it was labeled temporary volatility. The message was simple and consistent. Everything is functioning as expected, but we have to ask the crucial question: functioning for whom? It certainly wasn't functioning for the institutions that were desperately scrambling to find high-quality collateral to post for their loans. It wasn't functioning for the dealers who were suddenly demanding higher haircuts, essentially saying, the collateral you're giving me isn't worth what you think it is. And it absolutely wasn't functioning for the hedge funds that were forced to unwind massive positions they had built on the assumption of endless, cheap liquidity. They were the canaries in the coal mine, and they were suffocating. The real collapse, the one that truly matters, didn't begin when the public finally noticed and the stock market tickers turned red. It began much earlier. It began when the underlying conditions of liquidity shifted quietly, invisibly, mathematically, in ways that only a handful of people knew how to read. The failure was baked into the code of the system long before it became a headline. This is the story of that collapse. The one America pretended not to see. The one that was buried under layers of reassuring press conferences and headlines about temporary stress. It is the story that reveals a truth so uncomfortable that most people would rather ignore it. Systems don't just fail when people panic. They fail when the incentives are so warped that being honest becomes impossible. They fail when telling the truth is more costly than perpetuating a lie. Before we dive deeper into the specific mechanics of how this all works, the repo markets, the collateral chains, the shadow banking system, I want to offer a soft reminder. If you value explanations that go beyond the headlines and reveal the true mechanics driving our world, this channel exists to help you see what most people overlook. You're here, you're watching, which means you're already ahead of the curve. You're early. And in the world of finance and information, being early is the only place where truth lives before it gets packaged and sold as news. So let's start with the first piece of the puzzle, the repo market. Most people have never heard of it, but it's the most important market you've never heard of. Imagine a giant, overnight pawnshop for financial institutions. Banks, hedge funds, and money market funds go there every single day to borrow or lend trillions of dollars against high-quality collateral, usually government bonds. It's the grease that keeps the gears of the entire global financial system turning. If it stops working, everything stops working. In the months leading up to the crisis, strange things started happening in this market. The overnight lending rate, which should be incredibly stable, started experiencing wild, unpredictable spikes. This meant that the cost of borrowing money, even for a single night, was becoming erratic and expensive. This was a 5-alarm fire inside the system, but on the outside, all anyone heard was a faint, distant siren. The institutions that needed cash were having to pay a premium, a sign that lenders were becoming nervous. They were starting to question the quality of the collateral being offered, or they were simply hoarding their own cash, afraid of what the next day might bring. This wasn't just a technical glitch. This was a vote of no confidence. The very players at the heart of the system were telling each other, "I don't fully trust you, and I don't fully trust the assets you're holding." When that trust erodes, liquidity vanishes. And when liquidity vanishes, forced selling begins. Funds that can't roll over their short-term loans are forced to sell assets to raise cash. But when everyone is trying to sell at the same time, asset prices plummet. This creates a death spiral. Falling asset prices mean collateral is worth less, which leads to more margin calls and more forced selling, which pushes prices down even further. This is how the invisible tremor becomes a visible earthquake. It starts with a subtle shift in trust and liquidity in a market no one watches, and it ends with a full-blown crisis that everyone feels. The narrative of an unforeseeable accident is a convenient fiction. The reality is a predictable failure, born from a system that prioritized leverage and complexity over stability and transparency. As we continue this journey, we'll uncover more of these hidden mechanisms. We'll look at how the chase for yield pushed investors into riskier and riskier assets, and how financial engineering created products so complex that almost no one understood the dangers they contained. The tidy narrative is comfortable, but the truth is where the real lessons are learned. Stick with me, and we'll uncover them together. To understand the collapse America pretended not to see, we can't just look back a few months. We have to go back decades, to the moment the entire financial system quietly rewired itself around a single, powerful idea. Liquidity is everything, and everything can be used as collateral. Long before the worrying headlines, long before Treasury auctions started showing weakness, long before the repo market began screaming stress, the foundations for this collapse were poured. It all started in the 1970s. That's when America cut its ties to the gold standard and embraced a brave new world. In this world, credit, not physical money, became the lifeblood of the economy. This wasn't just a small policy tweak, it was a fundamental change in the architecture of global finance. Under the gold standard, the limits were clear and finite. You couldn't just print endless amounts of money. But under a credit-based standard, the constraints became invisible, structural, and even psychological. The financial system suddenly had the freedom to expand much faster than the real economy, the one that actually produces goods and services. Debt growth became the engine of economic growth, and liquidity, the ease with which assets can be bought and sold, became the oxygen feeding that engine's relentless expansion. But here's the catch. Liquidity is incredibly fragile. It doesn't just fade away slowly, it vanishes in an instant. And every decade since the 1970s has taught us this same brutal lesson, just in a different disguise. In 1987, the stock market crashed despite a booming economy. Why? Because liquidity dried up in a matter of moments. Fast forward to 1998, and the hedge fund long-term capital management nearly brought down the entire global system. Their strategy was built on massive leverage, all resting on the assumption that markets would behave predictably forever. They didn't. Then came 2008. The world learned the hard way that even AAA-rated securities, the supposedly safest investments on the planet, can become worthless when confidence evaporates and no one is willing to buy them. Each of these events was different on the surface, but the underlying mechanism was identical. First, the value of the collateral starts to fail. Second, liquidity collapses. And third, the ugly truth finally comes to light. But the most dangerous collapses aren't the loud, spectacular ones that make the front page. They're the ones no one sees coming, the ones that emerge not from a single, massive failure, but from a series of silent, hidden incentives that build up over years. This brings us to the modern era. America has built an economy that doesn't primarily grow from old-fashioned things like productivity, innovation, or exports. Instead, it grows from creating more and more credit. Think about it. Banks lend money against collateral. Hedge funds borrow money against collateral. Dealers use collateral to access leverage and make bigger bets. And at the very top, the Federal Reserve manages the entire system's liquidity by influencing the value and availability of that same collateral. When you zoom out, you realize the modern U.S. economy isn't just a traditional market. It's more like a giant, complex collateral engine. And just like any engine, can start to malfunction long before any smoke appears. By the time the public finally sees the flames, the system has already been burning internally for months, maybe even years. The collapse America pretended not to see began in the one place it should never have started: the U.S. Treasury market. This is, without exaggeration, the most important financial market in the world. Historically, U.S. Treasury bonds were the safest, most liquid assets known to mankind. They were the bedrock of global finance. But then came years of quantitative easing, or QE. The Federal Reserve bought trillions of dollars worth of these bonds, moving them from the open market onto its own balance sheet. This had a profound effect. It reduced the available supply of these pristine assets, tightening the availability of the very collateral the entire system relied on to function. The financial system had grown massively, but the pool of high-quality collateral needed to run it was shrinking. Then, the Fed reversed course and started quantitative tightening, or QT. The pressure that had been building for years suddenly reversed, and it did so violently. Trillions of dollars in treasury bonds started flowing back into the market. But there was a problem. They were ending up in the hands of those who needed them most. The big banks, the dealers, faced new regulations that limited how many bonds they could hold. Foreign buyers, who used to be reliable customers, started slowing down their purchases, and money market funds found it more attractive to park their cash at the Fed's own facility rather than buying short-term treasury bills. The result was a silent liquidity drought. It wasn't a shortage of money, but a critical shortage of high-quality collateral. Historically, when the treasury market gets tight, the repo market acts as a pressure release valve. We saw this in 2019, when a sudden spike in repo rates sent shockwaves through the system. But in today's world, that pressure valve is no longer guaranteed to work. Regulations put in place after 2008 limit the ability of dealers to step in and absorb stress. New clearing rules have increased the demand for margin, and sophisticated hedge fund strategies, like the basis trade, have created enormous hidden leverage, making the system incredibly sensitive to even tiny changes in yields. In the period from 2023 to 2024, a familiar pattern began to emerge, one that looked eerily similar to past crises. The prices in the futures market started to diverge from the prices of actual Treasury bonds. The spreads between them widened, a clear sign of stress. Dealers started demanding more collateral for loans, and trillions of dollars were being drained from the banking system as money funds chose the safety of the Fed's overnight facility. These weren't just a few isolated glitches. They were deep, structural symptoms of a system stretched far beyond its breaking point. And yet, what did we hear from policymakers? They described conditions as normal, orderly, and well anchored. Why the disconnect? Why pretend not to see the warning signs flashing red? Because acknowledging the truth would mean admitting a taboo reality. The U.S. financial system is not built on inherent stability. It's built on constant injections of liquidity that can never be allowed to stop for too long. The moment that liquidity tightens, the official story must not. The narrative must remain positive at all costs. And that is why America pretended not to see the collapse forming. Because in a system so dependent on confidence, perception itself is one of the last and most important tools for maintaining stability. History doesn't announce its collapses with a bang. There's no dramatic opening scene, no sudden, cataclysmic event that everyone sees coming. Instead, collapses begin silently. They start with incentives, hidden in the spreadsheets and balance sheets of the financial world. It's a bank deciding to hold just a little less in reserves to boost its quarterly profit. It's a hedge fund taking on just a bit more leverage because the market feels stable. It's a dealer accepting a maturity mismatch, borrowing short to lend long because the spreads are attractive and seem reliable. Policymakers, tasked with oversight, often downplay the risks. They do this to avoid creating panic, believing that confidence is the system's most important asset. And investors? They believe the official narrative because, frankly, what other truth is readily available? The system tells them everything is fine. And for a while, it is. This exact script, this quiet, insidious buildup, has played out time and time again. And it replayed itself, almost note for note, through 2023 and 2024. The first whispers of trouble came from the very heart of the financial system, the U.S. Treasury market. The auctions, normally the bedrock of global finance, started to show subtle signs of strain. They weren't disastrous failures that would make headlines, but something was off. The bid-to-cover ratios, which measure the demand for government debt, started to fall. This meant fewer buyers were showing up for each dollar of debt being sold. As a result, the primary dealers, the big banks obligated to buy whatever is left over, were forced to absorb more and more government bonds than they actually wanted. At the same time, foreign demand, especially for key maturities, began to weaken. Now, if you're a financial historian, these signals should send a shiver down your spine. These are the exact same precursors we saw before the liquidity crises in 1994, the taper tantrum in 2013, and the repo market seizure in 2019. Each time, weakening Treasury auctions were the canary in the coal mine. But this time was different, and much more dangerous. The system had far less resilience. The overall leverage was higher than ever before, and the buffers designed to absorb shocks were thinner. While the foundation was trembling, the rest of the structure was piling on more weight. Corporate America became increasingly dependent on short-term funding markets. Companies were refinancing record levels of debt, often by rolling it over every few weeks or months. This created a huge vulnerability. If those short-term markets ever seized up, a wave of defaults would be inevitable. Meanwhile, the private credit market was booming. This seemed like a good thing, a new source of funding for businesses. But much of it was built on opaque structures with very little secondary liquidity. If you owned this debt and needed to sell it quickly, who would you sell it to? The regional banks, which we thought had been shored up after the turmoil in early 2023, were still quietly bleeding. They were suffering from slow but steady deposit outflows. People were moving their money to bigger banks or higher-yielding money market funds. This forced many regional banks to do something they never thought they'd have to sell their long-term securities at a massive loss to cover withdrawals. And what about the average household? People were carrying record-high credit card balances, with interest rates also at record highs. A silent march toward delinquency and default was well underway. Individually, none of these issues was a full-blown collapse. A weak Treasury auction, struggling regional bank, a household missing a credit card payment, these are just isolated problems. But together, they were like dry timber accumulating in a forest. Each piece added to the flammability of the entire system, just waiting for a spark. When you look at how policymakers behaved, the modern parallels to past crises become even sharper and more alarming. Historically, the Federal Reserve is the firefighter. When liquidity dries up and the market seizes, the Fed steps in with overwhelming force to get the system working again. But in the lead-up to this collapse that America pretended not to see, the Fed seemed to be looking in the wrong direction. They either misread the signals or, perhaps more disturbingly, chose to ignore them. Their public focus was relentlessly on inflation data. CPI, PPI. These were the numbers that dominated every press conference. But the real danger wasn't in the price of goods. It was unfolding in the liquidity data from the financial system's plumbing. The Fed celebrated the resilience of the employment numbers, pointing to a strong labor market. But this strength masked a deepening fragility in the funding markets that are the lifeblood of the economy. They executed the most rapid rate hiking cycle in decades without seeming to fully grasp the consequences for the Treasury market. How could the government fund its massive, persistent deficits by issuing trillions in new debt if the cost of that debt was skyrocketing? It was a fundamental contradiction. Most critically, they persisted with quantitative tightening, or QT, draining reserves from the banking system. They continued this process even as bank reserves drifted down toward levels that have historically been associated with financial instability. If you look back at the patterns of 2008, 2019, and even the flash crash of 2020, it's painfully clear. The Fed is a reactive institution. It acts only when something breaks in a very public and undeniable way. But the breaking always begins privately, in the shadows of the financial system. It starts with the quiet withdrawal of liquidity, a process that is invisible to almost everyone except the few traders and risk managers who are close enough to the plumbing to smell the smoke. The collapse America pretended not to see wasn't a single event. It wasn't a Lehman Brothers moment that happened on a specific Monday morning. It was a chain reaction, a slow-motion pile-up that had been decades in the making. It was accelerated by the structural fragility of a system built on ever-increasing debt. It was masked by comforting narratives from policymakers and Wall Street analysts. And it was hidden deep inside the complex mechanics of collateral, liquidity, and leverage, the three forces that truly govern modern finance. Every historical collapse teaches us the same quiet, uncomfortable truth. Systems don't fail when they look weak. Everyone is cautious when things look weak. No, systems fail when they look their strongest. They fail when record profits, low volatility, and confident pronouncements blind everyone to the structural brittleness building up just beneath the surface. Strength becomes a liability because it breeds complacency. And by the time the weakness finally becomes visible to everyone, the collapse is already too far along to stop. We have to understand that today's financial system is not the gold-based world of a century ago. It's not even the post-war Bretton Woods system that our parents grew up with. It is a collateral-based, liquidity-dependent engine. It's a high-performance machine that can run at extraordinary speeds and generate immense wealth. But it has one critical vulnerability. It can only function as long as no one dares to lift the hood and see how fragile the inner workings really are. In the end, the story of this collapse isn't just about misreading data or being caught by surprise. It's about a collective choice. America didn't just fail to see the collapse forming. It chose not to look. The signs were there for anyone who was willing to see them. But looking would have been uncomfortable. It would have required hard choices and short-term pain. Here's a story with a twist, and it starts with the simple truth almost no one ever notices. A financial collapse doesn't begin when the markets start to fall. It doesn't begin with panic selling or scary headlines. It begins in silence, when someone, somewhere, quietly decides they no longer trust the collateral sitting right in front of them. That moment is completely invisible. It's invisible to the public, invisible to journalists, and invisible even to most investors. But deep inside the plumbing of the financial system, in the funding markets, trust evaporates in an instant. And when it does, every single assumption the system was built on starts to crumble. The collapse America pretended not to see began the very moment a handful of powerful institutions, we were talking primary dealers, huge leveraged funds, the liquidity desks at major banks, stopped accepting certain U.S. Treasuries at the same value they had just weeks before. How could the safest assets in the entire world suddenly lose trust? It's about how quickly you can sell something for cash without losing your shirt. And in the early stages of financial stress, even a tiny, almost imperceptible change in how quickly a bond can be sold, or at what discount you have to post it as collateral, triggers a massive chain reaction. It's like a line of dominoes you can't even see. Dealers tighten their lending terms. Funds start unwinding their trades. Hedge funds caught in a popular strategy called the basis trade get hit with margin calls they weren't expecting. And suddenly, a market that looked perfectly stable and calm on the surface begins to fracture along these invisible fault lines. This was the first big twist. The system didn't break because the economy got weaker. It didn't break because consumers panicked and rushed to the stores. It didn't even break because inflation was high. It broke because the collateral engine, the very machine that powers the entire U.S. financial system, began to seize up, one microscopic, rational decision at a time. When this collateral stress begins, it doesn't cause an immediate, public market crash. Instead, it creates a second, deeper, and much more dangerous problem: liquidity hoarding. Think of it like this. Financial institutions stop lending to each other. They don't do it because they see a crisis happening right now. They do it because they sense one is forming on the horizon. They feel the ground shaking tregs before the earthquake hits. Overnight funding, the grease that keeps the wheels of finance turning, becomes harder to get. Longer-term funding becomes more expensive. The big treasury dealers, the market makers, start widening their bid-ask spreads, making it more costly for everyone else to trade. At the same time, money market funds, which manage trillions of dollars in cash, start redirecting their flows. Instead of lending to the banking system, they start parking their cash at the Federal Reserve's overnight facility. It's a safer bet for them. And the banks, seeing their reserves obst lower, stop extending new credit at the margins. They pull back just a little. Every single actor in this chain is making a small, perfectly rational decision to protect themselves. But when millions of these small rational decisions compound, the system as a whole becomes completely irrational. Liquidity, the lifeblood of the market, disappears in complete silence, long before it disappears in the prices you see on your screen. That is the heart of this collapse. It was a crisis formed not from a sudden, blind panic, but from the slow, intelligent, self-protective actions of the very institutions who understood the system's plumbing better than anyone else. They didn't intend to trigger a systemic event. They were just looking out for number one. But in the world of finance, incentives aren't about intentions. You have to follow the incentive, not the headline. And this brings us to the cliffhanger. We have to examine what happened next, because once liquidity begins to dry up, once the system starts to seize, there is only one entity on the entire planet with the power to stop the downward spiral: the Federal Reserve. In every major historical crisis, 1987, 1998, 2008, and even the repo crisis of 2019 and the chaos of 2020, the Fed has always followed the same playbook. It waited until the system publicly failed, until the crisis was on the front page of every newspaper, before stepping in with overwhelming force. They're the financial firefighters, but they usually wait until the building is already engulfed in flames. But this time, something was different. The warning signs were everywhere, flashing like bright red flares in the night sky for anyone who knew how to read them. Bank reserves were falling. Treasury auctions were getting weaker, meaning fewer buyers were showing up. The spreads in the repo market, a critical funding source, were widening. There were clear signs of collateral shortages and stress in those basis trades I mentioned. Foreign demand for U.S. debt was deteriorating, and money market funds were pulling liquidity out of the banking system at an alarming rate. Each of these signals, on its own, was a serious warning. Together, they were a blaring siren. And yet, the Fed stayed committed to its policy of quantitative tightening, or QT. It kept interest rates high and continued shrinking its balance sheet, draining even more liquidity from a system that was already gasping for air. They were tightening the screws even as the mechanics of the system were straining and groaning under the pressure. This set the stage for the final, unavoidable break. Because in a world that runs on collateral, the moment the primary liquidity engine stalls, the entire system becomes just one shock away from a full-blown cascade failure. The Fed saw the signals. The dealers saw the signals. The money funds saw the signals. But the public did not. Why? Because the public doesn't live in the funding markets. The public lives in the headlines. And the headlines, right up until the very end, said everything was under control. The economy was strong. The system was resilient. There was nothing to worry about. The truth is much simpler and much more sobering. By the time America finally admitted a collapse was forming, it had already happened. The silent crash had already taken place deep within the financial plumbing. The real question we need to ask now is why? Why was the system allowed to reach that breaking point? And what hidden mechanism, what structural flaw, made this entire collapse not just possible, but inevitable? That is where we are going next. Because the collapse America pretended not to see wasn't an accident. It wasn't bad luck. It was baked into the very structure of the modern financial system, just waiting for the moment when incentives aligned and the pressure reached a point that no amount of narrative, no amount of positive spin, could possibly hide. America pretended not to see the hidden mechanism that was about to bring everything down. It starts with a simple, devastating reality. The modern financial system doesn't run on money. It runs on collateral. And when that collateral fails, everything fails with it. To understand why a collapse became unavoidable, you have to look beneath the surface. Forget the headlines, the yield charts, and the Fed policy statements. The real story is in the mechanics of the system, the plumbing that keeps global finance alive. This system isn't built on cash. It's built on confidence in the reliability, liquidity, and tradability of U.S. government debt. That confidence is what determines leverage, what dictates risk, and what shapes the flow of trillions of dollars across the globe. But in the years leading up to the crisis, that confidence was being systematically dismantled, not by some sudden shock, but by structural cracks that grew wider every single day. The first crack was the sheer explosion of U.S. government debt. Between 2020 and 2024, the U.S. added over $1 trillion in new debt. And when you include rolling over old debt, the total issuance was more than $20 trillion. The government was spending like there was no tomorrow, with projections of trillion-dollar deficits for the next decade. Now, here's the problem. This tsunami of Treasury bonds hit the market at the exact moment that the financial system's ability to absorb them was shrinking. Think of it like trying to pour a river into a bathtub. After the 2008 crisis, new regulations like Basel III and the supplementary leverage ratio were put in place. These rules forced big banks and dealers, the primary market makers for treasuries, to hold more capital for every asset on their books, including ultra-safe government bonds. This meant they couldn't just expand their balance sheets to buy up all the new debt the government was issuing. They were legally constrained. To make matters worse, the Federal Reserve, which had been the buyer of last resort for years through quantitative easing, was now doing the opposite. They were shrinking their balance sheet through quantitative tightening, or QT, pulling liquidity out of the system just when the government needed it most. This created a mechanical mismatch. A record supply of collateral flooding the market, with not enough balance sheet space to hold it. The plumbing was clogged. The second major problem was a ticking time bomb at the heart of the Treasury market, the basis trade. This is a highly leveraged arbitrage strategy used by hedge funds. It sounds complicated, but the idea is simple. They would buy actual Treasury bonds and simultaneously sell Treasury futures contracts, pocketing a tiny difference in price between the two. In normal times, this trade helps make the market more efficient. But by 2024, it had grown to a monstrous scale. Research suggested that leveraged funds had over $600 billion in exposure, with some estimates putting the true figure, including derivatives, at over $1 trillion. The basis trade is like a perfectly balanced Jenga tower. It only works if two things are true. You have access to cheap, unlimited borrowing, and the value of your collateral stays stable. But leading up to the collapse, both of these pillars started to crumble. The cost of borrowing in the repo market, the place where these funds get their leverage, started to rise. Dealers, constrained by their own balance sheet limits, started tightening their lending terms. And when they started asking for more collateral for the same loans, a process called increasing haircuts, the entire Jenga tower began to wobble. Leveraged funds faced a cascade of margin calls, forcing them to sell assets to raise cash, which pushed prices down further, triggering more margin calls. This is the exact same doom loop that almost blew up the financial system in March 2020. Back then, the Fed stepped in with unlimited money printing to save the day. But this time, the Fed wasn't easing. It was tightening, draining reserves, and publicly insisting that everything was fine. It wasn't. The third crack in the foundation was the drain of reserves from the banking system. When the Fed started quantitative tightening, it was effectively vacuuming up cash from the commercial banks. These reserves are the lifeblood of modern banking liquidity. In 2022, when QT began, banks had around $3.8 trillion in reserves. By early 2024, that number had fallen to around $3 trillion. But the total number isn't what matters most. It's the distribution. At the same time, money market funds were pulling over $2 trillion out of the banking system and parking it at the Fed's own facility, the RRP, which offered a safe, risk-free return. This double whammy drained reserves and pushed some banks dangerously close to the liquidity cliff that caused the repo crisis back in 2019. The Fed has a secret number, a theoretical floor for reserves called the lowest comfortable level. It's the point where liquidity stress goes from manageable to chaotic. The problem is, nobody, not the public, not the market, and by their own admission, not even the Fed knows precisely what that number is. And by mid-2024, the warning lights were flashing red everywhere. Banks were tapping emergency lending facilities more often. Reserve levels at regional banks were dropping, and government debt auctions were starting to show signs of weakness, with fewer bidders and weaker demand. Yet, the official narrative from Washington and Wall Street remained dangerously calm. That brings us to the fourth problem. The world was losing its appetite for U.S. debt. For decades, foreign buyers like Japan and China were reliable customers, absorbing a huge share of America's borrowing. But that was changing. Japan, facing its own economic shifts, started to find its own domestic bonds more attractive. China, locked in geopolitical tensions with the U.S., was slowly but surely reducing its Treasury holdings. And oil-exporting nations, who once recycled their petrodollars into U.S. debt, were now diversifying their wealth or using the money to support their own economies. The result was a profound shift. The foreign buyers who once propped up the Treasury market were stepping away. This put all the pressure on domestic buyers, the banks, the money market funds, the hedge funds, to pick up the slack. But as we've seen, those very institutions were already constrained by regulations, liquidity drains, and the allure of parking cash at the Fed instead of buying bonds. So, you had a simple, terrifying equation. Treasury supply was going through the roof, while structural demand was falling off a cliff. The gap between those two lines was the fault line, the seismic crack running directly beneath the entire global financial system. The fifth and final piece of the puzzle was the slow-motion decay of the collateral itself. Not in terms of credit risk. Everyone still believed the U.S. would pay its debts. The problem was liquidity. Older Treasury bonds, which make up the vast majority of the market, were becoming harder and harder to trade. The market was becoming fragmented. Collateral markets, especially for repo borrowing, heavily prefer the newest, most liquid, on-the-run Treasuries. But the system was increasingly forced to rely on these older, off-the-run bonds, which couldn't be funded as cheaply or traded as quickly. This was made infinitely worse by the fact that the overall depth of the Treasury market had evaporated. Market depth is a measure of how many buy and sell orders are sitting there, ready to trade. According to the Fed's own research, Treasury market depth had fallen by more than 70% from its pre-2008 levels. This meant that even small trades could cause huge swings in price. In times of stress, the market for U.S. government debt, supposedly the safest, most liquid market in the world, was behaving like a penny stock. This is the complete opposite of how we're all taught to think about treasuries. We assume they are infinitely liquid, perfectly stable, and always tradable. They aren't. And that's the hidden mechanism behind the collapse. When the most important collateral in the world loses its liquidity, the leverage systems built on top of it begin to seize up, one by one, until the entire machine grinds to a catastrophic halt. Let's talk about the sixth problem, the Federal Reserve itself. The Fed thinks it runs the show with interest rates, its balance sheet, and public statements, but in reality, doesn't control these things in the way it imagines. Rate hikes? They don't have the same bite in a world where shadow banking creates synthetic credit through derivatives. What about so-called quantitative tightening, or QT? Sure, it drains reserves from the system, but it's not the total amount that matters. It's where those reserves are located. If they're in the wrong places, the system still comes under immense stress. And communication? Talking can calm markets for a little while, but words can't fix deep, structural problems. The Fed's real power is its ability to stop a collapse by printing money and expanding its balance sheet. But here's the catch. It can only use that power after the collapse has already started and is visible to everyone. Before that, its hands are tied by politics. This is exactly why financial crises always seem to come out of nowhere. They don't. The pressure builds up invisibly until the moment the Fed is finally forced to act. The collapse America pretended not to see followed this script perfectly. Pressure built, the quality of collateral weakened, and liquidity vanished. Dealers were strained, hedge funds hit their breaking points, and banks were running low on reserves. Even Treasury auctions started to fail. But the Fed insisted on continuing to tighten its policies. And when you mix tightening with a fragile system, things get brittle. All it takes is one shock, and the whole thing shatters for everyone to see. The seventh problem, and this might be the most important one, was the over-reliance on Treasury futures as a signal for market health. Futures markets are big, liquid, and usually efficient, but they are not the same as the actual cash market for Treasury bonds. The growing difference between futures prices and cash prices became a massive red flag. When the spread between them widened, it was a clear sign of stress in the funding markets. But people on the surface just dismissed these signals as technical noise. They weren't noise. They were the screams of a system that was starving for balance sheet capacity. There's a popular strategy called the basis trade that made all of this worse. It amplified the distortions. A tiny shock in the funding market could force huge players to unwind their positions, causing a sell-off in cash treasuries, which would widen the spreads even more, creating a vicious feedback loop. This is exactly why institutions like BlackRock, the Bank for International Settlements, and multiple central banks have repeatedly warned that these leveraged trades are a systemic risk. But as long as the trade was profitable, it continued. Incentives create fragility long before anyone is willing to admit it. Now for the eighth problem, the structure of U.S. government debt. The country's fiscal situation got significantly worse. For the first time in history, the interest payments on the national debt grew larger than the entire defense budget. As interest rates rose, the government's borrowing costs went up. Higher borrowing costs led to bigger deficits. Bigger deficits meant the government had to issue even more debt. And issuing more debt put even more pressure on a market that was already struggling with weak demand and not enough capacity to absorb it all. This is a classic doom loop, a mechanical, mathematical certainty that gets more dangerous the longer rates stay high. The collapse America pretended not to see wasn't caused by one single bad auction. It was caused by the crushing weight of a fiscal reality that no amount of positive spin could hide. The more the government borrowed, the more stress it put on the very funding markets that make that borrowing possible in the first place. The ninth problem was the silent decay of the banking sector. Regional banks were still sitting on massive unrealized losses from the rate hikes in 2022 and 2023. They were struggling to keep depositors who were moving their money into higher-yielding money market funds. The FDIC reported that these unrealized losses on bank balance sheets exceeded $470 billion at one point. These losses didn't matter on paper, as long as the banks held the securities until they matured. But when the liquidity stress hit and banks were forced to sell, those paper losses became very real. We saw this pattern with Silicon Valley Bank, Signature, and First Republic. And the exact same pressures were building up again in the years leading up to the collapse quietly, invisibly, and dangerously. On paper, the banking system looked solvent. But beneath the surface, the liquidity stress was reaching a boiling point. As reserves dwindled and the competition for deposits got fierce, banks were forced to borrow from the Federal Reserve's discount window, a move that carries a heavy stigma and signals deep, underlying fragility. And that brings us to the 10th problem, the global dimension. The U.S. financial system doesn't exist in a vacuum. The entire global dollar funding market relies on U.S. Treasuries as the ultimate, safest collateral. So, when the market for that collateral starts to break down, funding conditions tighten all over the world. The Bank for International Settlements often highlights how dollar shortages pop up during these periods of stress. The eurodollar markets amplify these shocks. You see it when the cost for foreign institutions to swap their currency for dollars skyrockets. These pressures were all appearing quietly before the collapse. The Japanese yen weakened as Japanese institutions scrambled to hedge their dollar exposures. Europe experienced its own funding strains. Emerging markets found it harder and harder to get their hands on dollars. These are all signals of a global liquidity squeeze, one that starts in the U.S. collateral system and then spreads like a virus everywhere. The collapse was a global event long before it was seen as a national one. When you put these 10 problems together, the mechanics of the crisis become undeniable. The supply of government debt surged while demand for it weakened. Liquidity drained from the system. Leverage expanded to dangerous levels. The quality of collateral deteriorated. Banks and dealers' balance sheets were strained. And into all of this pressure, the Fed continued to tighten. This wasn't bad luck. This was the result of a flawed structural design. The collapse America pretended not to see wasn't a surprise. It was the inevitable outcome of incentives, constraints, and the cold, hard math of a financial system that depends on collateral reaching its absolute limits. Every single data point we've talked about: Treasury issuance, repo market exposure, reserve levels, auction results, foreign demand, market depth, basis spreads, cross-currency signals, all of these were flashing bright red long before the general public had any idea something was wrong. And yet, the narrative in the media and from policymakers remained calm, because the narrative is always the last thing to break. Reality breaks first. This is the mechanism that drives a crisis. A system built on collateral liquidity cannot survive when that liquidity disappears. A system that depends on the capacity of banks and dealers cannot function when that capacity is constrained. A system fueled by cheap leverage cannot withstand higher funding costs. And a system that relies on the Federal Reserve as a backstop cannot hold up when the Fed's hands are tied by inflation, politics, or just a fundamental misreading of the risks. What made this collapse so uniquely dangerous wasn't the size of any one problem. It was the combination of all of them happening at the same time, quietly, under the surface, in a system where fragility doesn't just add up, it compounds exponentially. America didn't see the collapse because it didn't want to see it. Policymakers had every incentive to project stability. Markets had every incentive to believe the story. Financial institutions had every incentive to continue their profitable trades. And the average person had no visibility into the plumbing of the financial system. And yet, the plumbing is where the truth lives. Treasury liquidity, repo spreads, reserve balances. These are the real indicators of systemic health, not the stock market, not the unemployment rate, not GDP, and certainly not the headlines. When you follow the mechanics, you see the collapse coming long before anyone is willing to admit it's here. And the final, devastating truth is this: collapses don't happen when systems are weak. They happen when they are overstretched. They happen when confidence runs far ahead of reality. When temporary liquidity is mistaken for permanent solvency. When feel-good narratives overwhelm the cold, hard mechanics. They happen when the entire structure becomes so dependent on everything being perfect that the slightest change becomes a crack, the crack becomes a fracture, and the fracture becomes a total break. The collapse America pretended not to see wasn't a story about markets. The truth behind this collapse is painfully simple. America didn't fail to see the warning signs, it chose not to. Why? Because acknowledging the cracks would mean acknowledging a deeper, more uncomfortable reality that our entire system is built to avoid. And that reality is this: liquidity is a belief system, and belief systems don't break slowly. They break all at once. Think about it. When collateral thins out, when reserves start to fall, when funding spreads widen, when bond auctions get weaker, and when leverage becomes brittle, the system doesn't politely whisper that something is wrong. It stays eerily quiet. It stays quiet right up until the precise moment that silence can no longer hold the weight of reality. And when that moment finally arrives, everything that was invisible suddenly becomes undeniable. A common misconception is that markets just move on their own. They don't. Markets are moved. They are pushed and pulled by the incentives of massive institutions that understand liquidity far, far better than the public ever will. The collapse America pretended not to see didn't happen because inflation was high, or because consumers were weak, or because sentiment turned sour. No, it happened for a much more fundamental reason. It happened because the very architecture of modern finance reached its mathematical limit. You can postpone a reckoning with narratives. You can suspend disbelief with splashy headlines. You can try to reassure investors with confident speeches from on high, but you cannot bend the plumbing of the financial system. And when that plumbing finally breaks, the truth arrives brutally, without any room for negotiation. The consequence of this isn't just lost wealth or volatile markets. It's much deeper. It is a whole generation of policymakers being forced to confront a structure they inherited but never truly understood. A structure where debt consistently grows faster than income. A structure where the quality of collateral determines the economic destiny of nations. A structure where massive liquidity injections are used to mask serious solvency risks. And a structure where the Federal Reserve isn't really a guardian of stability, but the final, last resort emergency mechanism when all other defenses have already failed. The warning here isn't just about a single crisis. It's about the path the entire system is on. As government deficits continue to climb, as bond issuance increases, as foreign demand for our debt weakens, as hedge funds leverage deeper and deeper into complex basis trades, as banks sit on enormous unrealized losses, and as households stretch their credit to the breaking point, the margin for error shrinks. It gets smaller and smaller every single day. Every structural problem we have becomes self-reinforcing. Every cushion that was once there to absorb a shock becomes thinner. And as a result, every shock that hits the system becomes sharper and more painful. And every policy response becomes more constrained, more difficult to implement. This isn't a cycle. It's not some normal up and down. It is a trajectory. And what comes next depends entirely on the decisions that are made when the illusion of safety finally breaks for good. Some systems can reset gently, others collapse violently, but no system, none in history, can survive on denial indefinitely. The people who navigate these moments best, the ones who come out ahead, are the ones who understand the hidden mechanics. They understand the incentives, the pipelines, the flows of capital, the balance sheets. They look past the stories being told on television and focus on the raw data, because the truth doesn't hide in headlines. It hides in liquidity, and liquidity always tells the real story first. You were never supposed to see this collapse forming. You were supposed to believe that everything was under control, right up until the moment control became impossible. That's the design, and that's exactly why this channel exists. We're not here to predict doom or to sensationalize fear. We're here to help you see the architecture beneath the narrative. We want to show you the plumbing, so that when the next warning comes, it won't be invisible to you. You'll know what to look for. If this deep dive has helped you understand the mechanics behind the story, the signals, the incentives, the structural pressures that truly move the markets, then stay connected with us. There's so much more to uncover. Share this video with someone you know who still believes that markets move on emotion instead of the cold, hard mechanics of financial plumbing. Help them see what's really going on. And remember this: power is never about what they show you, it's about what they hide from you.